So over here it's related to the bond investment. Over here it's related to the bond investments. So whensoever a company is in need of funds, what does it do? Actually, let us have a look at the different avenues from where the company can basically have the resources. So where the company is having the resources. So first of all, it is related to the capital that is being basically invested by the owners itself. So who are the owners for the limited company or the public limited company? It would be the shareholders. So we can say the company can basically raise the capital from the market itself by issuing the shares itself, and further that is not to be returned because that's a long term capital. And other than that, the company can issue the debt instruments. The company can issue the bonds and debentures. So bonds and debentures are what? These are the debt instruments. These are the debt instruments. These may be secured, these may not be secured. And further, whensoever a debt instrument is issued by the company is having the obligation so as to pay them back. So as to pay it back. In the case of the capital, so employed by the shareholders, that is not to be paid back. That would be an ultimate liability on the company when the company would be liquidated. Otherwise, it would not be. But in the case of the bonds and debentures, there will be an obligation on the companies itself so as to repay it. And also the company will be paying the interest component in the form of the coupon itself. So let us have a look at the different components of the bond that you will be receiving. So let us take the case that there is a 100 rupees bond, and whenever I say that there is a 100 rupees bond, it is said to be what? It is said to be the face value of the bond. It is said to be the face value of the bond. The face value is basically of the bond is what? It is basically the amount that will be getting at the maturity of the bond. So let us take the case that the person A has invested rupees 100 into the bond itself. And further, it's a 100 rupees bond and it is for 3 years, and the person A will be receiving 8% of the coupon. 8% of the coupon. Now coupon is what? Coupon is the interest rate that will be paid by the company itself. And further, the coupon will be paid on the face value. The coupon will be paid on the face value over here. And further, we are saying the coupon will be paid each and every year. We are basically taking the frequency of the payment of the coupons to be yearly over here. In that particular case, how much amount will be paid to the person over here each and every year for the next 3 years? It will be rupees 8 that will be paid to the person A over here for each and every year, for year 1, for year 2, for year 3. And further, also at the maturity of the bond, that is at the end of the 3 years over here, in that case the person A will be receiving rupees 100. That is said to be what? That is said to be the face value at the end of the maturity of the bond itself. That is said to be what? That is said to be the redemption value, that the person will be redeeming the value in the end itself. That will be the face value that will be receiving. Okay, so what would the total inflows? There is two type of inflows that the investor will be receiving. One, it is the inflows in the form of the coupons, and further it is what? It is related to the face value. It is related to the face value or redemption value that the person will be receiving on the maturity of the bond itself. Okay, when the company is issuing the bonds directly to the bond investor, that is basically related to what? That is related to the primary market. So when the company just issued the bond instrument and for the person A invested directly and purchased the bond instrument from the company itself, that is said to be what? That is basically related to the primary market itself. That is said to be the primary market itself. You can relate it to the share market. When the shares are directly issued by the company, those are said to be IPO. That is related to the primary market. And further, when the shares are being sold and purchased among the shareholders, that is said to be what? That is said to be the secondary market. So over here we are talking about the primary market, where the bond was issued by the company. Bond was issued at a face value, and the company is paying an interest rate that is in the form of the coupons. And further, on the maturity, the person will be receiving the redemption value too. Okay, so that is related to the primary market. Now when the bond is being purchased among the bond investors, that is basically related to what? Let us take the case that there are other investors too, and further they also are basically selling and purchasing the bonds over here. So that will be forming what? That will be forming the secondary market. That will be basically forming the secondary market over here. Secondary market over here. And let me tell you a clear-cut solution to the questions over here that is related to the interest rate and the bond price. So there is inverse relationship between the bond prices and the interest rate. There is inverse relationship between the interest rates and the bond prices. What does it signify? It signifies if the interest rate is on rise, if the interest rate is increasing, then the bond value will decrease. And if the interest rates are decreasing, the bond value will increase. Okay. Now let us have a look at the different type of the bonds. Then we'll be covering the important terms related to the bonds so as to understand this in much detail. So over here it is related to the bonds. So there are different type of bonds. First of all, it is related to the convertible bond. So convertible bonds are those bonds which can be converted into the equity, which can be converted into the shares at a specified rate at a specified time period. Okay, so at the particular time period, at the end of the particular time period, the bond can be converted into the share itself, into the equity itself. That is said to be what? That is said to be the convertible bond. So such bonds basically provide what? Such bond provides an opportunity to the investors that they can participate in the equity. So let us take the case that the bond that you purchased was at ₹100, and further you were receiving 8% coupon each and every year, and that was for next 10 years. And you were provided with an option that you can convert into the equity at the end of 5 years. At the end of 5 years, you can convert into the equity. Now, at the end of 5 years, let us take the case that the share of the price when you invested into the market, when you invested into the company itself, the share price was rupees equal to rupees 200. Let us take the case that the share price was equal to not rupees 200. Let us take case it was rupees 100 only. It was rupees 100 only in comparable to the bond investment. But now after 5 years, the share price is equal to 300. Definitely, you will be converting your debt into what? You will be converting your debt into equity. And why the company would be benefited? Because the company has not to repay. Now the amount to the bond investors over there. Because I already told you that bond is basically in the form of the debt. It is in the form of the debt, and the company is having the obligation so as to pay it back. But if it is equity, then the company is not having the obligation so as to pay it back right now. The company will be paying it back only and only in the liquidation itself. Okay, that is related to it. That is related to the convertible bond. Now let's move further. It's related to the callable bonds. Now what is a call actually? Call is basically related to an option that so as to purchase. So in the case of the callable bonds, when the issuer reserves the rights. Now over here, the bond issuing company will be reserving a right that they can call back, that they can purchase the bonds, and further they can pay the fixed prices for the same. That would be a basically term and condition related to it, and there will be an option to the bond issuer that they are having a right reserved, that they can basically do what? That they can purchase the bonds after some particular time. And further it is related to floating rate bonds. So in the case of the coupon rate bonds that we have considered so far, in that particular case, the bond investor is being paid a fixed amount of the coupon. But in the case of the floating rate bonds, the interest rate paid will not be a fixed rate. It will be a floating rate. And they will be repricing to it. As such, in the loan amounts, there is a floating rate applicable, that your interest rate that basically changes after some particular period. That basic scenario will be applicable to that particular bond also. That is said to be what? That is said to be floating rate bonds over here. Then it is a case of the negotiable bonds. Otherwise, the person who has invested in the bonds, he will be basically taking care of the bond itself, and further will be redeeming the bond on the maturity itself. That is basically not negotiable. But if it is negotiable bond itself, in that particular case, the person who is holding the bond, that would be the owner, that is meant to be the owner of the bond, and further that is said to be what? That is said to be the bearer bond itself. So if you basically give the bond to some other person for some value, for some consideration, that basically it can be negotiated. That is said to be what? That is said to be the negotiable bond itself. And further, it's very much important concept that it is related to the zero coupon bond. Now what is zero coupon bond? As the name suggests, no coupon will be paid. So if I say that the face value is ₹100, and no coupon will be paid, and further on the maturity you will be paid the face value itself. So what would be the benefit to the investor itself? Over here? So let me tell you, in the case of the zero coupon bonds, the bonds are issued at discount, and there is an intrinsic yield related to it. So let us take the case, if it is a zero coupon bond, in that case particularly it will be issued at discount. Let us take the case, the bond was issued at ₹60, and on the maturity, the bond investor was paid the par value. What does par value indicate? Par value indicate basically the face value of the bond. So whether we say the par value or we say the face value, both are basically same. Is that clear? So that is related to the zero coupon bond. Is that clear?